Good morning. Happy Monday. Happy Monday. Good morning. Good morning. It's a great morning, and I hope you guys are feeling good. Listen, I hope your week has been off to a good start. And if you're starting off your week here with me, well, you're in for a treat today because we get to hang out and we get to chat. And you get to learn about the very first step of the financial foundation pyramid today. And today is going to be a lot of education, a lot of learning, and a lot of note taking, especially if you're not familiar with insurance. And one of the biggest things I have to just first off start by saying is that you can build wealth in other ways. You can build wealth in other ways than without starting with insurance. Now, unfortunately, if you don't have it in some capacity as a part of your wealth plan, then it will be very, very difficult. But there are ways to do that. But if you really, truly want to make sure that your family is set up for legacy generation, or excuse me, for generational wealth, then you're going to need life insurance, one, and you're also going to need different levels of protection. And so today we're diving into the first foundation of the financial foundation pyramid. There are 4 sections of the financial foundation pyramid that I'm going to teach about. I've already taught at a basic level the overall financial foundation pyramid. If you've missed that episode of the podcast, you're going to need to go back a few episodes and actually find that. But I got this comment, and I've also got this question from one of my clients as to why protection has to be a part of that. And even though I talked about it briefly then, it prompted me to say, you know what? I think we need to do a full deep dive in all 4 steps of the financial foundation pyramid, because each of these 4 are extremely important. And without one of these puzzle pieces, you will have a very hard time building wealth. Now, this is definitely for like middle America to be able to get a good understanding. But a lot of people who can at least start somewhere, at least start the bottom of this financial foundation, is going to do much better as they try and go up as well. And so over the next few episodes, we're going to dive deeper. We're going to dive deep into the 4 of these different steps: protection, debt management, emergency fund, and investments, in order to help you ultimately build a good base of financial foundation. A good base is very necessary for building wealth, which we've talked about wealth building tools and strategies and all those things before. And I will continue to do that, especially when it comes to entrepreneurship, right? Especially when it comes to business ownership, taxes, and all the rest of that stuff. But this is just strictly the base of all of your wealth building, of everything, the financial foundation pyramid. That's the start of it. So without these 4 being taken care of in this order, or with these levels of priority, then it's going to be extremely difficult for you to build wealth. And so that's why today we're going to dive into protection, which is the very bottom of the base, which needs to have the most priority when it comes to you building your financial foundation. So I hope that you guys are doing well. Before we get into today's episode, I am going to show a sponsorship from one of our sponsors here on the channel, which is Gamma AI. If you've not been here on the channel to see some of my Gamma AI slides, then you're going to be in for a treat. I'll be back in just a second. Today's podcast is brought to you from an amazing, beautiful partnership or sponsorship. I guess I wouldn't say that as a partnership. This is from Gamma AI. So I know AI, right? Everybody absolutely hates AI. They can't stand AI. They're, oh my God, AI this, AI that. It's absolutely crazy. But listen, Gamma AI is amazing. They are who I who I use presentations for. I can even create some like social media, LinkedIn carousels and some individual posts just from what I want. And I get to go in and I get to tell it to create, different sorts of images and artistry based on what I put into it. Like my notes,
I take a lot of notes when I'm at business conferences. I take a lot of notes when I'm creating trainings, and I write down my different prompts for my own podcast episodes, my own trainings, the speeches that I do, the books that I read, and the books that I've written. I take a lot of notes, and so I can just simply upload my notes and my thoughts straight into it, and it'll create me just beautiful pieces of content and social media art presentations for both business and then also for you guys too. And if you follow me on social media anywhere, whether it's TikTok, LinkedIn, or any, you might have seen a few of them. I haven't used it as much as I like to, but you might have seen me use it a few, and it is just so simple and very easy. And also, I haven't even paid for it. So with that, guys, just be sure to check out gamma.ai, I believe. Check them out. This isn't a sponsorship. This isn't an actual sponsorship, but they have been absolutely incredible at some of my content. I took the transcript from my podcast and just put it in and told it, hey, just make me a LinkedIn carousel that looks professional, that I can actually use. And it made these beautiful, I did a little bit of a couple tweaks too, because sometimes it might end up, it's still using a little bit of AI. So I needed to make sure that it actually still kept everything that I wanted. So I made a few little tweaks to it. But after that, it made this beautiful carousel for me. And so I know a lot of people are like, AI is taking over the world. Well, maybe it doesn't have to take over the world in a way that a lot of people are actually using it. But maybe instead, you can use it to improve on your content, and you can use it to improve on what you're putting out as well.
Yes. So make sure you guys check out Gamma app. It's going to be amazing. It's going to be a game changer for your content, for your content platform. Trust me on that one. So with that, guys, let's just go ahead and get right into. That's not the button now. Let's go ahead and get right into today's lesson, today's episode. Bam, bam. All right. All right. So I've got my handy dandy notepad, drawing pad here, for us to be able to dive into some writing and drawings that you guys know I love to draw. And even though it's so funny. And we'll get into this. Even though I can, I can type everything on here, and make it nice and clean and easy to read. I think somehow I just prefer to make it harder for people to read, because I think if I make it harder for you to read, you'll pay more attention to the words that I'm saying or to what I'm talking about. Now, I want to be very, very honest and very, very upfront. As I told you guys before, I am a tax-free retirement planner. That is what I do in my firm. That is the entire goal of me, of whenever I work with families, to generate a tax-free retirement and also to generate legacy. All right. And that is the entire goal, So life insurance protection is one of the services of our firm, right? As well as debt management, emergency funds, and also investments and retirement planning. And estate planning and things like that, right? So I'm going to be very upfront. That is one of the things that we do at our firm, and that's why I'm also teaching on these topics. Granted, that's why I even have the podcast overall, because a lot of the things that go into building a legacy, one of the things that goes to building a legacy, or building wealth, or building a tax-free retirement, are all the things that I talk about here on the channel, even when it comes to entrepreneurship, right? As I've mentioned many times before, entrepreneurship is the way out of the poverty tax. Entrepreneurship is a way into favorable taxes, right? Especially tax-free retirement planning. It is also a really great way to bring in additional income, right? Things like that. But entrepreneurship can really build a great legacy for your generations to come, especially if it's through some sort of business that you can pass down, right? Insurance, life insurance is one way to also build a legacy. It is also one way to protect your life and protect yourself. So I'll be very honest and very upfront. Life insurance is a big part of what it is that I do in helping people to build tax-free retirement plans. So what I'm going to teach you today is not just for right now, right? It's like for future planning as well. It's for legacy planning. It's for when you get sick and injured and ill. Because I want to be completely like honest with you. And this might be very rough to hear, but it is worse to be sick. It's worse to get sick, better to pass away. Worse to get sick, better to pass away. And you might be hearing me say that as I'm about to teach you about the 3 types of life insurance and be like, wow, you're really trying to sell this. No. Actually, quite the opposite. Something that you need to learn deeply about life insurance. Before we dive into this, tell me this. If you've got car insurance, right? Let's say you've got car insurance and you're driving down the highway and some car in front of you hits a nail into the window, into your windshield. I'm going to knock on wood for that. You got this wooden desk for these kind of conversations, right? And let's say it doesn't completely shatter your windshield, but it does put a crack in it, and it's obviously very concerning. Who's going to have to pay to replace your windshield? Would your car insurance company pay to replace your windshield? Or would you have to pay a deductible? Right? What happens? Like, how does that process work? To be honest with you, for the most part, most car insurance companies are only going to pay at the end of life of the car, right? If it gets totaled or something like that, right? Are they going to just pay for a windshield, right? Just some? No, most likely, not often, right? Certain types of insurance will. This specific situation has happened to me before, where that exact situation happened to me. There was a crack in my windshield, right? And sometimes you either have to pay a deductible, and then they'll cover the rest of the cost. Sometimes they won't cover it at all. Very few times will they completely cover it, and they not bring the cost of your insurance up monthly or anything like that. Wouldn't that be beautiful? In my case, I didn't have the money. And whenever that happened, I didn't even have the money to replace my windshield. So it took me like about a day or two before I finally was like, okay, this is worried me enough when I'm driving. I need to at least see if my insurance company will help me pay for it, and then I can figure out a plan, because I didn't have the money to replace my windshield. And so whenever I put the claim in for the windshield, at that point, Geico, they actually fully paid for my windshield to get replaced. They paid for my windshield to get replaced. They scheduled the appointment with the replacement company, with the garage. They got me a date, and also the garage, just because it was the closest one near me, the garage was a glass tinting garage. So I also got a free, nicely tinted windshield. Didn't have to pay anything out of pocket. My premiums didn't go up or anything. But tell me something. If they had not replaced it for me, I would have had to come out of pocket for that. And at that point in time, I didn't have money. I didn't have any emergency funds. I didn't have things to be able to take care of that. So it shortened the life of my vehicle. And since it shortened the life of my vehicle, that means I'm probably gonna have to come out of a lot more money sooner, much sooner, to buy another car, right? What could have happened? Anything could have happened. I could have been driving, and another thing could have hit my windshield and completely shattered it while I was driving, causing a major accident, major crisis. And then guess what? The insurance company would come out of pocket for that. They would pay for that some, or I would have to pay a deductible. They come out of pocket, right? Things like that. But most insurance companies, they only pay at the end of the life of the product. They only pay at the end of the life of the product. Do we really want our insurance to only pay for the end of the life of the product when we can't have it anymore, when we can't use it anymore, like the product, when we can't use the car anymore? I don't want, I want my car's life to be extended. I want to use my car as long as I possibly can. Same thing with my home, with my renter's insurance, with my homeowner's insurance, right? Same thing with my health. I want my health right? Your health is your product, is a product. I want my health to be extended as long as possible, right? Now, health insurance isn't life insurance. And I'm gonna be honest, a lot of people get the two of those confused. A lot of people get the two of those, when it comes to the hatred for them, right? When people say that they hate insurance, a lot of times they're talking about health insurance because of all the horror stories that they hear. They hear, oh, they didn't accept my claim, or they didn't accept my cousin's claim, my grandmother's claim, or something like that, and they lump life insurance into that, generally speaking. And so whenever you talk about life insurance, they generally just hate. Oh my God, I hate insurance. Whoa. I mean, and there's a lot of other reasons why people hate insurance as well. But that is one of the things, right? But when it comes to health insurance, your health is the product. You want your health to be sustained as long as possible, right? You don't want health insurance to only kick in when you've completely got no health, right? When it's gone. And then same exact thing with life insurance. You want your life is the product. You want your life to be sustained as long as possible, right? You don't only want it to kick in at the end of life when you cannot even have it, when you don't have any more of life. Like you don't have any more of your car. Your car's done. You don't, yes, that is very necessary, right? And that does help with the cost of the next product, or the cost of the next one, right? If at the end your car's totaled or something like that, then the insurance paying out will definitely help you buy a new car. At the end of life, the insurance paying out would definitely help your family, right? So in those cases, what I want to say is, what is the windshield to your life, right? What is the windshield to your life? What can happen to your life while you're alive? Here's Max. What's up, Max? I forgot to close the door, didn't I? Yeah. What can happen to the windshield to your life where your life can be shortened, right? Cancer, stroke, heart attack, chronic illness, right? Terminal illnesses, things like that. You need daily assistance. You can't move. You can't bathe. Things like that. That is a big concern. And so whenever I say that it is worse to get sick than to pass away, that's what I mean, because of how expensive it can be to get sick. Because of how expensive it can be to get sick. And now we're not talking about the expenses and the cost of just being sick today, right? We're not diving into that. Maybe I can do that on a different day, on a different podcast episode, maybe in a different series. But the reason why I say that is because as I said, I have life insurance as a part of one of the services in our financial planning and retirement planning firm, okay? But the way that I believe in life insurance needs to sustain your life. I don't want anybody to pass away. I never want for any of my clients to pass away and have to use their life insurance. Never want it. I never want it. The unfortunate reality is that everyone will pass away. But the other part about that is, how do I make sure that their lives are sustained best through the insurances that they have, right? How do I make sure that the life of the product is sustained most through their insurance products? And so that's why I want to provide insurances that will do that, right? The auto, property, casualty, things like that. I want to sustain the life. Most insurance agents, they sell insurance for the end of life. That's fair. It kind of, I get it. It kind of sucks because it could be almost predatory to a lot of people. It can be very predatory to a lot of people because they're in their brain, they're thinking, wow, you're capitalizing on people's death. You're capitalizing, you actually are trying to sell something that somebody actually needs, and you can ultimately Like, you know that they need it, so you can set parameters, your own parameters. And like, I do get that. I do get that. That's why I had a hard time at first, like even wanting to deal with insurance. And this was years ago. I told you guys I've been in tax planning, tax preparation, and estate planning for about 10 years now. And so around that point in time, before I really understood the tax benefits of insurance, right? Because there's also tax benefits as well. Before I understood the tax benefits of insurance, I didn't want to deal with insurance at all. Whenever I would come across insurance and estate planning, I'm like, I don't want to have to deal with this. I don't want to have to deal with insurance. What? Like, it's a scam, or it doesn't work, or they deny claims, and all those things, all the same things. But then I learned how insurance works with estate planning. Then I learned how insurance works with taxes, tax planning, right? And now I understand how insurance can sustain your life. I mean, literally after that moment of my car with Geico, and I was like, wow, I didn't have to pay for this at all. And now this helped me out. One, I didn't come out of pocket. And also two, they just helped my vehicle. Like, now I have a better vehicle, kind of, in my brain. I was like, wow, I wish all insurances did that. Crazy thing is, all insurances have the ability to. It just depends on the company that you work with. Shockingly enough. And also, not all life insurance companies are going to pay for the life of you, right? They're not even most of them. Not even most of them are going to pay for the life of you, right? They're only going to pay for the end of your life, okay? But that doesn't make sense, because then that's just death insurance to me. So in our firm, the insurances that we sell all types of insurances, all types, all of them. Whatever type of insurance you want, we'll sell with whatever companies. But when it comes to my firm, us planning it for part of your financial plan, or when it comes to how we add it into your financial foundation pyramid, we want to use and find the best ways to sustain the life of you. That's like the major point. And then also use it for building a legacy as well, right? But that's a big piece of it. So whenever I talk about insurance today, I'm talking from an understanding that I want to sustain the life of you, one, and two, that also later on we can also pass a legacy. And we'll talk more about passing legacy, because I feel like some of that comes into the investing part, right? But we'll also talk about some of that today. So now, with kind of pre-framing that, now let's get into the three types of insurance. All right, beautiful. So I love this. My brother, I just saw your podcast TikTok. By the way, if you're not subscribed on our TikTok, at ReforgedHQ podcast, you can find it there. I'm on, I like that. I'm going to start listening for motivation. I'm on that journey right now, putting money away in a high-yield savings account. Great job. I've been learning about simple investing like EFTs and index funds. I'm about to start investing some of it. That's amazing. That's so awesome. It's also funny that he just came across my TikTok. We just rebranded the TikTok. So we got a whole new TikTok channel and deleted the old one. So that was a little bit hard for me, because I didn't want to part with it, but we did it so that way we could try and reach better or larger audiences as well, and kind of use these podcast clips as that. I do plan on doing other content as well, but as we continue to grow, then I do more of that content. All right, so the three types of insurance, and I'm actually going to not talk about universal as much right now. I'm going to talk about that last. We're going to dive into permanent and temporary first. So diving into the three types of life insurance. And I hope I can get this done in the next 30 minutes. If I can't, then we'll just have a part 2 to this today. Because when I normally teach this, is about an hour to an hour and a half to my clients, right? Whenever I teach them about insurance, like on their insurance day, it's about an hour to an hour and a half. So that way they fully understand, they fully grasp the concept. But then if you guys are financial professionals or insurance agents or planners or anything like that, then I'm going to cut and segment this and put it on our YouTube channel, so that way you can then just send this directly to any of your clients and they can be able to understand if you agree. And if you don't agree, let me know in the comments. But let's dive into it. So the three types of insurance, but the most two prominent ones are permanent and temporary. Simple, super simple. One is permanent, one you have all your entire life, and the other one is temporary. It goes away. All right. So super simply, the type of insurance for permanent, you've got whole life insurance. Now, when it comes to like a lot of the companies that you run into with whole life insurance, or excuse me, with insurance, a lot of companies that are just insurance firms, right? Insurance companies, not insurers. Like the insurer is the actual direct company that is providing the insurance to you. But then there are brokers, or there's brokerages. There's also agencies or firms that sell the insurance to you for or on behalf of the company. All right. So a lot of companies are actually in the business of selling whole life insurance, and whole life insurance being permanent makes sense. The unfortunate downside is that there's so little education on whole life insurance. And so a lot of those companies, they're not teaching you. They're not going to teach you the vast span of insurances. They're just going to tell you, hey, here's life insurance. This is what life insurance is. And yes, most people are familiar with whole life insurance. Most people are familiar with whole life insurance, but temporary insurance, this is term insurance. Term insurance. And more people have term insurance than whole life insurance. More people have term insurance than whole life insurance. Here is why. So most often when you encounter life insurance, is probably through your job. And if you get insurance through your job, it is only temporary because, well, most of the time temporary, because you're not going to work at that company forever. All right. And as I have told you guys before, group versus private, when it comes to exclusivity, the more exclusive something is, the better the product. But group is something that means that you and multiple people fall into the umbrella of that. So when you get a job, you will likely get some sort of group policy, meaning that you are compared to the group, to the employee force. This is one of the most common forms of life insurance that most people have, is a term insurance policy. This means that it will expire. It will expire after a certain period of time. It will expire. Max 30 years. Now, if you got a group policy, likely it will expire when you are done working with them, right? They typically won't set you up for saying, hey, you only get term insurance for 10 years while working with us if you expect to work there for 30 or 40 years, right? This is what most people are they most often have, but typically if they are going, what most people know about is whole life insurance. That's what most people know about, right? So you'll get group policies from work, and then also most people know whenever they work and sit down with a company, they're going to get whole life insurance. Now, you can have your own private insurances as well. You can have your own private insurances as well as group. You can also have group whole life policies. You can have group whole life policies. There are some out there. There are group whole life policies out there. So you have group and you can have private. Now remember, the more exclusive, the better the product. So if you select private, the reason why you would select private over group, right? Group would mean that you're attached to multiple people and you're being compared across multiple people. As an example, in the military, we have group insurance, right? So if I am slim and I'm fit, I'm in shape and I'm healthy, my insurance is going to cost the same exact amount as the guy next to me who is out of shape. He is out of shape, overweight, can't run, things like that. It's going to cost the same amount. Now, I'm going to be compared across him and everybody else in the group that is getting covered. So my insurance will likely be more expensive than what it would be if I had my own private insurance. But for that guy who is unhealthy, who might not even ever be able to qualify for his own private insurance, is going to be cheaper for him than what it would be private, if he could even get qualified for his own private insurance. Private insurance looks at you as an individual and your health, your risk class. So if you are generally more healthy than the average person, you should and will likely have a cheaper premium than you would if you got group. And then also on top of that, private coverage offers typically better benefits than group coverage. Reason being is because less exclusive, meaning that if you got a group policy, they don't want to provide like great benefits to the masses, right? Like as an example, let's imagine that you've got your I'm going to choose health insurance, right? So you have group health insurance, you have private health insurance. So let's imagine that you work at this company and they've got group health insurance. That health insurance company would not want to provide $0 deductibles to your group. Why? Because then they don't know the risk class of everybody there. They don't know how unhealthy everybody is. So why would they want to give a $0 deductible to them, to everybody? When then they can just take completely advantage of that and everybody can be extremely unhealthy at that job, right? So they're not going to provide that benefit, but you might get an amazing benefit of like a $50 deductible yourself, and versus like the group having a $250 deductible, $1,000 deductible. So you just get better benefits because you're being weighted only against yourself with private versus group. And you can have group whole life and group term policies. So that's what it is when it comes to type of insurance. Permanent means that it goes up to 100 years old. Temporary or term, you've got as little as 10 years up to 30 years. And then sometimes you can get like 35 or 40 years and things like that. And then again, if it's group, then it just depends on the company. All right. So now let's talk about some of these benefits. Actually, I want to move this down here. So now let's talk about some of the benefits of these, of the differences between them. So the benefits of whole life, we've now established that this is whole life and this is term life. Benefits of whole life policies. So as I said before, it is permanent. So that means that you have it until age 100. So whatever amount of policy you get, whether it's a $10,000 policy, $250,000 policy, $1 million policy, you have it until the age of 100. It's awesome. With that, what happens at age 100 then? Like if you pay into it every month up until you're 100 years old, well, what happens at that point in time? Well, if you make it to age 100 without passing away, they will return, or they will give you the 100 that whatever your death benefit is. They'll give you your death benefit. So again, if your death benefit, let's say your death benefit was $100,000 for you to, if you were to pass away, then I give your family $100,000. If you make it to age 100, they will give you that $100,000. They would just give you that $100,000, and you have a life insurance policy anymore. Now, at that point in time, if you make it to that point and you're still living, like, first off, kudos to you. Keep up. I hope that you're living a healthy life. But then second off, you want to make sure that that money doesn't just get blown, right? Because you will need the money for passing away. But if you make it to age 100, they give you that $100,000. Now, with whole life, since they're going to give you this $100,000, that means that it is building cash value. It is building cash value. Now, tons and tons of insurance professionals who sell life insurance use this as the largest benefit. And I'm going to be honest with you, whole life insurance builds cash value like worse than a high yield savings account. If you are using whole life to build cash value, stop. Like if you're using it for simple purposes, just building cash value, stop. There's going to be some specific examples I'm going to give later on and some strategies where I talk about when this is useful. But as far as if you're like, if you are sold a whole life policy and someone is telling you, hey, this also builds cash value, you can use this for your child's, like college education, stop. Don't do it. Don't do it. It builds cash value so minimally. I'm talking like, depending on the company, 2 to like maybe 5.5%. Okay. Maybe that 5.5% is a stretch. Is a stretch. All right. So there are some other ways to kind of to think about this, but I'm going to dive into that when I get to the strategies part. But it builds cash value. So that's the good part, but it's going to build the cash value up to that $100,000, right? The difference with this cash value is the fact that with the cash value, you can take loans on the account. You can take loans on your insurance, right? When a lot of people talk about taking money out of their insurance, they're talking about taking money out of their whole life policy. And again, if you're planning on using your whole life policy, especially let's say you're like 35 years or 30 years old, don't. You got so many other options, right? So many other options to build cash value than life insurance, right? It is great because it's building cash value tax-free. You're building cash value tax-free, right? So that's a good part. But during the accumulation phase of your life, there are much better products to build cash value in. I mean, once we get to talking about universal life, that's a better way to build tax-free cash value. Tax-free accumulation, right? Much better ways. Now, another benefit is that there are different types of whole life, all right? You've got just regular whole life, right? Regular whole life, where you buy it, you pay for the rest of your till you're 100, and you get the cash. There's also a couple differences, right? There are different ways to pay. So as an example, you've got like, you'll see 20 pay, you'll see 10 pay, you'll see paid up at 65. I'm just going to go at 65 instead of paid up at 65, but paid up at 65. This 20 pay means that you only pay for 20 years and then you've got the insurance the rest of your life. This 10 pay, same thing, but 10 years. Paid up at 65 means that you pay only until you're 65 years old and then you've got insurance the rest of your life. Now, obviously, a couple things with that is that they're going to take all your premiums and shove it down to 20 years. Now, they're also going to give you a discount, right? They're going to discount it because you're going to be paying in lump sum, generally, like in a way, right? You're paying in technically lump sum. But then we got 10 pay, even shorter, right? So they're also still going to give you a discount as well. And then paid up at 65, similar. And that doesn't matter from where you are. If you're 20 years old, if you're buying a policy for your brand new baby, right? If you're literally 60 years old, you can do paid up at 65, and it'll just go into your 65. They'll just shove those premiums down to that point. A lot of families, they'll get 20 pay for like their babies because they want to pay for their first 20 years and then want them to have life insurance the rest of their life. But to be honest with you, a lot of times, something like this, they'll probably get like $10,000 or $20,000 or so of death benefit, right? Something small. So those are the different ways to pay. Then you've got different types of policies. So as an example, you've got regular whole life, but then you've also got what's called final expense. You got final expense, which the purpose of this is literally just to pay for your funeral, your medical expenses. That's it. right? So you can get regular whole life. Example, you can get, let's say $250,000 of death benefit. Final expense, maybe like $25,000. That's it. That's all you need for funeral, final medical expenses. Maybe you should definitely think about or consider the amount of money that you would want in case of someone passing away, or you passing away, your family member passing away, and you wanted to take extra time off of work. That will make sense, right? Like, imagine if you make $10,000 a month and you decide that you want to take 2 weeks off after a loved one passes away, right? Then maybe you add about $5,000 to this for also taking time off. That's something that a lot of people don't think about, because obviously you don't probably have all the time off in the world, especially if a loved one passes away. You probably spent a lot of your paid time off going to be with them in hospital or going to take care of them or so. You probably don't have much time off. So it makes sense to add in some time off money. Granted, if you've got a whole family, then it probably makes sense to add in a lot more of that, right? Depending on the family. So depending on your situation, it will make sense to, final expense also makes sense to add in some extra money. Right? But on average, an adult needs about $20,000 for a final funeral, medical care, medical expenses, probate, things like that. And then add in those other expenses for a child, for if they pass away, God forbid. I'm not going to do it again, just because, maybe about $7,500 total. So you got regular whole life and you got final expense as well, right? Then there's other things like AD&D, like accidental death and dismemberment, which that kind of sucks because that only pays out in the case that you die specifically from an accident. As an example, AD&D, accidental death and dismemberment. Let's just say that you get into a car wreck, right? And it punctures your lungs or something like that. It pushes your chest in, and you're in the hospital. Let's say that you end up getting pneumonia, right? If you get pneumonia, that sucks. Obviously, you probably got pneumonia because you had a compromised lung. And then let's say you pass away a couple months from that pneumonia because you couldn't recover. Well, even though the accident is what caused you to have lung issues, and then you got pneumonia and you died technically from the pneumonia, you did not die from the accident. So they won't pay out that accidental death and dismemberment. A lot of people don't realize that. And then also a lot of people think that accidental death just means like you died of natural causes. That's not accidental death. Because in people's brains, they think accidental death, oh, well, I wasn't murdered, like, or I didn't commit suicide, or like I didn't die because of some life-threatening thing, right? Like cancer or something like that. So like that was an accident that I died. No. Oh, they strictly mean there is some sort of accident that happens and you die strictly because of that accident. Let's say that the accident punctured your lungs and you just could not recover, and then you end up passing away because you cannot breathe anymore. That's accidental death and dismemberment. And sometimes they will give you what's called indemnity, where they might give you 2 times or 3 times your actual death benefit to your family. So if you had, $20,000 of accidental death and dismemberment, they might give you 40 or 60,000, depending on how severe it was, depending on how long that you were in the hospital, things like that. So those are some of the benefits of whole life insurance. Some of the benefits of whole life insurance, right? Now, let's talk about temporary insurance, term insurance. What's some of the benefits of term insurance? So because it's temporary, it will expire, meaning that they don't need to cover you for all of your life. The likelihood that you will pass away during that term of 10 to 30 years is much less likely than whole life. With whole life, they know you're going to pass away, or they know you're going to make it to age 100. So they know they're going to pay you out. So it's whole life insurance is more expensive. We'll talk about that in drawbacks. But temporary insurance is cheaper. Cheaper. Is actually the cheapest insurance that you can get, because of the fact that the likelihood that you'll pass away is very slim. Very slim. So you won't be on that insurance all of your life. So it's much cheaper. And then also another big benefit of term insurance is the fact that you can get a lot more coverage. much more coverage with the premiums being cheaper, right? Like you really wouldn't want to have $1 million of whole life insurance. It's going to be extremely expensive. If you need $1 million of insurance, you should probably definitely look into term insurance instead, right? Because it's going to be much cheaper. Now, the coolest piece about whole life, one other thing I did not mention about whole life, I'm gonna squeeze it in up here. I'm gonna squeeze it in up here. And this is probably one of the biggest benefits. That's what I want to put at the top, is that premiums never change. Premiums never change. When you get it, that's it. It's the same for the rest of your life. Premiums never change. With temporary insurance, again, premiums don't change during the term. Premiums don't change during the term. So if you got it for 30 years, you just locked it in for 30 years. All right. Another great thing is it expires. It expires. And since it expires, that's a great thing, and also a drawback, because you should be using it for certain purposes, right? Let's just say that you are looking at your insurable need. Now, I've taught you guys about insurable need already, but your insurable need, you've got a mortgage. Let's say you've got 20 more years on your mortgage, right? And let's just also say that you've got maybe you've got an IUL, right, that covers $500,000 of your insurable need, and then your mortgage is $500,000 as well. So you need another $500,000. So you've got a total of $1 million of an insurable need, and you've got $500,000 of coverage somewhere else. And then also you're like, I won't need $1 million of insurance all of my life. I mean, once the house is paid off, I won't need $500,000 of it at all. Good thing is that you can use term insurance to supplement for those pieces of your life, the pieces of your insurable need that will not always be permanent, like your debt, mortgage, things like that. So you can get like a $500,000 policy knowing that you're only going to have it for 20 years for just the purposes of your mortgage. And then your mortgage is paid off, your insurance also expires. And now you don't have to pay for the insurance for that. And yeah, I'm not talking about, you've also got, homeowners insurance, right? But that's different than life insurance, right? Because if you pass away let's say you pass away 3 years into having your term insurance will be able to pay for the rest of the mortgage, and your family doesn't have to worry about that, right? But once you don't have that mortgage, you don't need that term insurance anymore. So it expires and you don't have to pay for that for the rest of your life. That's a good thing, right? If you were to get $1 million of whole life insurance, you're not going to be able to just reduce your whole life insurance later on down to $500,000, because you don't need that $500,000 anymore unless you get a declining insurance policy, which those aren't as great. All right. So it expires. It's cheaper. More coverage, premiums don't change. Some other really cool benefits is that with some companies, you get what's called living benefits. This is probably the biggest reason why I even sell any life insurance outside of like IULs. Biggest reason why I even sell life insurance outside of IULs is for the living benefits, or also known as accelerated death benefits. So accelerated death benefits or living benefits, some companies will pay money to you directly from your death benefit. Term insurance does not build cash value. It is not. So you can never just take money out of your term insurance policy. If anybody ever says that they take money out of their insurance, they're talking about permanent insurance, whole life or IULs, or universal life, I'll say. Whole life or universal life. Never directly from their term insurance. But term insurance and universal are the only ones that provide accelerated death benefits. You might be able to find a random whole life policy with some accelerated death benefits, but not nearly like full in the case of temporary benefits, right? With whole life insurance, if you get an accelerated death benefit, they're probably just going to pay you your policy in the case that you get diagnosed with a terminal illness, which is where you're going to die within the next 6, 9, 12, or 24 months because of some sort of illness. Like you are going to pass away. So they're just going to give you your whole life insurance up front. That's also one of the few pieces, one of the pieces of living benefits is that terminal illness where you're now terminal. They'll pay you your death benefit up front. So if you got $500,000 of death benefit, term insurance might, again, depending on the companies, term insurance might just pay you that $500,000 when you get diagnosed with that terminal illness. So that way you can pay for continuing treatments, right? Which could ultimately help elongate your life. It's a terminal illness, so the doctor says you're probably going to pass away at this point in time, right? But it might sustain your life a little bit longer with your family, right? Also, it could help out with some of the medications. It can help out with the cost of the care for your family, so that way they don't have to come out of pocket now or go into debt now. Things like that, right? That terminal illness, again, it's also typical in whole life insurance. Then you've also got chronic insurance as well, or chronic coverage as well. If I can spell today, chronic illness. This is more like if you suffer some sort of long-term care situation where you can't eat or you can't bathe on your own, you can't get dressed on your own, things like that, where you can't perform like 2 of the regular activities just to live and just to move around, right? If you cannot do 2 of those, it'll pay cash you either maybe in lump sums or like annual income to help you out with, again, elongating your life. If you need to go to a nursing home or you need private care or you need to pay a nurse to like take care of you daily, you need some like supervision, like it'll pay like, yes, your insurance can take money from your death benefit and give it to you. If you got $1 million, they might give you, $200,000 to be able to take care of that, to be able to take care of your ongoing treatment, which is huge. That's huge. Because once again, that sustains your life. Most people, they get into a position like that and they have to take from their 401k, which only then shortens their retirement plan. And if it's shortening your retirement plan, then also that's shortening your life, because then you're going to be more stressed and then you have to work more, go back to work or something like that, or have a very, very underfulfilled retirement. Or the third one is the critical illness. I spelled that much better. Critical illness. Let's say you get diagnosed with cancer, you have a heart attack, a stroke, blindness, paralysis, things like that, right? The windshield to your life. It'll pay cash, again, directly out of your death benefit to you. So that way you can continue living. And if you get diagnosed with, I had a client a year ago, it's happening all the time, but a client a year ago get diagnosed with colon cancer. Just after a week, just after signing one of his term, actually it was a universal policy, a universal IUL with us, and they actually paid cash to him to go get his treatment for cancer, and he's good, cancer free. And that happens all the time. So once again, if you have, life insurance with living benefits, while you're in retirement, you don't have to take extra money from your retirement plan. And it will not only sustain your retirement plan, but sustain your life. This is the biggest piece of why I even like insurance or life insurance in the first place now. One of the biggest pieces outside of tax planning and estate planning is because of these living benefits. So these are some of the benefits to temporary, to term insurance. Big benefits. So I'm going to have to dive into the drawbacks. I'm going to have to dive into the drawbacks and also strategies for these two on Wednesday's episode. But we got a lot out. We got a lot out today. We got a lot out today about the 3 types of insurance. I'm going to have to teach you guys more as well. Whole life. More on the next episode, or our next podcast episode. So that way you guys can understand much more. But what we talked about today so far is the 2 types of insurance, 2 of the 3 types of insurance. what they mean, what they are, also some benefits. I'll finish the drawbacks with the strategies, and I'll finish with universal life on our next episode. So this is going to be part one of the Financial Foundation Pyramid. And then Wednesday would be part 2 of part 1. So Wednesday would be 1.2 or something like that. So I didn't expect to get through all of it today. And that's okay. But with that, I am going to say that I am happy to be able to help out today and teaching you a little bit about insurance. And if you have any questions, that's fine. Go ahead and put them in the comments down below, wherever you're enjoying this podcast, whether it's on YouTube, Spotify, LinkedIn, Facebook, wherever it is that you're enjoying this. If you have questions about some drawbacks, some of the benefits that I just talked about, definitely feel free to ask in the comment section down below. You don't always just have to schedule an appointment, but I'd encourage you guys to schedule an appointment because we can dive into your specific case and answer quick questions for yourself. Right? Obviously, the education I give on the channel are very general, and we can only get specific. And I can only tell you, hey, no, whole life would be better for you, or term life would be better for you if we actually look directly at your case. So if you do have any questions, let us know in comments down below. I'd love to be able to help you guys out and answer those questions for you. And with all of that being said, have a beautiful week. Stay happy, stay cool. Stay relaxed. Make sure that you have a very fruitful and productive week. And I will see you guys on Wednesday. Take care.